Hi, welcome back. I was planning to do my last two data updates for 2025. After all, we're into February and I should be done, but I got sidetracked. I often do. First, I got sidetracked by my last update where I looked at the profitability of businesses. And one of the metrics I looked at was what I called excess return, the difference between what you earn on your projects, return on equity and return on invested capital, and your cost of equity and cost of capital. It's a flawed metric, but one that I think is useful to look at. And there were quite a few comments on my return on equity and return on invested capital that, to me at least, suggested there was some confusion about what an accounting return measures. A couple of days later, I was commenting on a LinkedIn post on computing an implied equity risk premium for the Indian market. And the person who had posted had done a really good job. They'd used my framework, but had extended it to the Sensex, which is a tougher index to estimate it for than the S&P 500 because the information is not always there. And they'd done almost everything right except for one assumption that got them into trouble, which was assuming that in an efficient market, the return on equity is equal to the cost of equity. And I pointed out the flaw in that rationale. I said return on equity has nothing to do with market efficiency. It's what you earn on your project. It's more reflective of the of competition in the product or service market the company operates, and then market efficiency. But as I reviewed the comments, and those comments increasingly went off track, it seemed to me that the core confusion about what accounting returns mattered is so significant that talking about any kind of metric related to it is dangerous. So I thought I'd take this session to set up a very simple example to illustrate what an accounting return measures, what market efficiency requires, and what absence of efficiency in the market allows investors to do. So let's start the game with a very simple exercise. Let's suppose you have two entrepreneurs. The first entrepreneur sets up business A, puts in $60 million right now up front, and it's a good business. He expects to make $15 million every year in perpetuity. So in our example, we'll keep growth out of it and the earnings last forever. The second entrepreneur also invests 60 million upfront, but it turns out that the business is not as good. That business generates 3 million a year in net income forever. Now, if you look at the accounting statement of these two businesses, they both will have 60 million as book value of equity. Let's assume debt is out of the picture, and both will have income statements, but one will show 15 million, the other will show 3 million. If I were computing an accounting return is based entirely on accounting numbers, accounting income and accounting book value of equity. The return equity for the first business will be 25% for company A, and for the second business will be 5%. Just to add some color to this process, let's assume that these two businesses have the same amount of risk, and that risk translates into a cost of equity of 10%. If you bring in that cost of equity, then basically what you have is the first business earns well above its cost of equity and the second business earns well below. A little pause there. An accounting number is just an equation, right? Net income, book equity. But when you get a return on equity, that number has economic significance. Take business A. When I argued that this business will generate a 25% return on equity forever and its cost of equity is 10%, implicitly, I'm making an assumption that I might as well make explicit, which is there are very strong barriers to entry to new businesses entering. Why do I need that? Because if I make a 25% return on equity in a business where I need to make 10%, others are going to try to enter the business and undercut me, take my returns away. It might take them a little while, but I'm not going to make 25% returns on equity forever. So whenever you see a business earn well above its cost of equity or cost of capital, it's your obligation in a sense to fill in the details. What are the competitive advantages? What are the barriers to entry? Or if you prefer the Buffett phrase, moats that this company has that allows them to earn those returns. The second business is a bit of a puzzle, right? You're saying, why would somebody invest in a business expecting to make 5% a year in perpetuity when the cost of equity is 10%? Well, you can't rule out irrationality. There are people who believe that if you make money on a business, you're succeeding. Maybe this person is comparing the 5% to a risk-free rate or something that he shouldn't or she shouldn't be comparing it to. But a far more likely scenario is they thought they were entering a good business, but something happened. Like what? Well, they had a product or service that they thought would fill a need. They could charge a high price, make a high return equity, but just after they invested the 60 million, but just before they get to market, a competitor comes up with a better product at a lower price and undercuts them. And to therefore compete now, you got to cut prices, and when you cut prices, your income suffers. Or it could be a regulatory change that you entered a market which was unregulated, and just as you got ready to introduce your product or service, price controls are introduced. So we'll come back and look at the question of what happens with bad businesses. But clearly, if I just paused here and asked you which one is the better business, it's no contest. Business A is better than business B, and the excess returns kind of measure that goodness or badness. Now, let's say a minute later, these two businesses list on the market. The entrepreneur wants to cash out. Let's see what the market will see in these two businesses. When it looks at company A, it sees 15 million a year in perpetuity with a cost of equity of 10%. It looks at company B, it sees 3 million a year in perpetuity with a cost of equity of 10%. You're saying, but they both invested 60 million. To the market, it's irrelevant. What matters is earning power. If this market is efficient, the first company, 15 million in income, should be valued at 150 million. Why? The cost of equity is 10%. 15 million a year forever is worth 150 million. The second company should be worth 30 million. 3 million a year forever, 10% cost of equity, 30 million. Now, this is a fair value. You're saying, why are you discounting net income? It's not a cash flow. In this particular example, the net income and the cash flow will be the same because there's no growth, and this company could pay out its entire net income as dividends every year and be okay. So in an efficient market, the first company A, will have a market value of 150 million, and the second company will have a market value of 30 million. You're saying, what about book value? Well, what about book value? If you compare the first company's market value to book value, it'll trade at 2.5 times book value. 150 divided by 60. The second company will trade at half of book value, and they're both fairly valued. Now, there were quite a few commenters on both my post and in the LinkedIn comment who seemed to think that return on equity could be obtained by taking the net income and dividing by the market value of equity. That's not net income. That's the inverse of the PE ratio. It's called the earnings yield, and the earnings yield for both these companies is 10%. In an efficient market, if there is no growth, and this is critical, we'll see how growth muddies the waters. If there's no growth, the earnings yield in an efficient market will be roughly equal to the cost of equity. So let's look at the implications of even this very simple example. First, if you look at those price to book ratios, company A trades at 2.5 times book value, company B trades at half of book value. And they deserve to, right? It's based on their earnings power. Both are fairly valued, and the fact that one trades at well above book value and the other trades well below book value is completely irrelevant. Now, why am I bringing this up? There are lazy versions of value investing. Let me emphasize, not all value investing, but lazy versions of value investing based entirely on the price to book ratio. That you should buy stocks that traded below book value, and you should sell stocks that traded above book value. Well, clearly that's not true, right? You could buy B, it trades at well below book value, but it's not undervalued. I think the reason for this lapse in judgment comes from the belief that book value of equity is somehow equal to liquidation value. We'll come back and address it, but it definitely is not. Here's the other implication. It relates to earnings yield. The last couple of months, you've probably seen commenters looking at the U.S. equity markets, in particular the S&P 500, and arguing that stocks are overvalued based on a very simple comparison. They've taken the earnings yield for the S&P 500, the inverse of the PE ratio, and it's now below the T-bond rate, and said, that's it, we're done. Because your expected return on stocks captured by the earnings yield is now less than what you can make on a guaranteed return, on a guaranteed investment. I confronted this question in my second data update, but you can already see why this approach is going to break down when there's no growth and you have perpetual net income. It is true the earnings yield is the cost of equity, and you can make this comparison. But we will talk about what happens when you have growth and you've got to bring in reinvestment. The earnings yield doesn't measure what you can earn as an expected return on equity. So, but let's clarify that what you talk about as return on equity is an accounting number. It's got nothing to do with net income divided by market value of equity. So let's extend this discussion. It's simplistic, but it gives us insight into a number of different issues that investors face. The first is the question of good companies versus good investments. Now, if you go back to the original example that I set up, company A was a good company, company B was a bad company. But to see why investing is different than assessing company quality, if both these companies are fairly valued, company A at 150 million, company B at 50 million, you're going to be indifferent between the two. What does that mean? You buy each of these companies, you will make a 10% return. Not bad investments, but not investments that beat the market. Let's say in the second scenario, company A is priced at less than 150 million, company B is priced at more than 50 million. You know what you will do? You'll invest in company A because it's undervalued. You won't invest in company B because it's overvalued. If the reverse is true, company A trades at more than 150 million, company B trades at less than 50 million, you'll buy company B, even though it's a bad company, a bad business, because it's undervalued, and you won't buy company A. If they're both overvalued, you'll buy neither. The fact that one is good and one is bad is irrelevant. What if they're both undervalued? If you can buy both, you should, right? But why do you have to choose? But if you have to pick just one, you'd pick the one that's more undervalued on a percentage basis. So when you look at a company, it's good to assess company quality. And that's what excess returns do. But that doesn't mean that you, as an investor, are going to be drawn to invest in companies that earn more than their cost of equity or cost of capital, because it depends on what they're priced at. Good investing is all about getting a company at the right price. So with that behind us, let's talk about the second issue, which is this comparison between return on equity and cost of equity, or return on invested capital and cost of capital. There are two components to that comparison. One is the accounting return comparison. The other is the cost estimation of equity and capital. And all too often, the debates end up being about the cost of equity and cost of capital. I don't like the CAPM, your beta is wrong, your risk premium is wrong. I'll concede all of those, but I'll wager that the amount of divergence you're going to get on cost of equity and cost of capital is tiny relative to the kinds of divergence you will get on the accounting return side. The weakest link is the accounting return number. And to see this, let's start with a couple of cases where return on equity and the true return equity and the reported return equity can diverge. First, as an accounting number, both return equity and return invested capital are extremely susceptible to accounting inconsistencies. Let's take a simple one. Let's go back to the example we had. Two companies where entrepreneurs both invest 60 million. The first business earns 15 million a year in net income. The second business makes 3 million a year. Now, let's assume that first business, company A, half of the 60 million had been invested in R&D. It's a long-term investment, right? It should be treated as a capital expense. But that's not what accountants do. They treat it as an operating expense. If they do that, in that first year, company A is going to report a loss of minus 15 million. Remember, they had net income of 15 million, but the R&D is expense that year. The book equity that company A will have will be only 30 million. The 30 million that's not R&D. And in the subsequent years, years 2 and 3, once the R&D has been written off, your return equity for this company would be 50%. In other words, you'll overstate the return equity and return invested capital for companies with significant R&D expenses, because those expenses now don't show up as part of the book equity or book capital. So that's the first problem. The second is, in the example that we had, it was, we looked at the book value right after the investment had been made. The 60 million had just been invested. The numbers were fresh. But as assets age, things happen to the assets. To begin with, inflation can wreak havoc on the numbers. So if you bought something in 1978 and record in your books, unless there's inflation accounting adjustment, which in much of the world we don't adjust for, that number will get less and less connected to what that number should be today. So inflation is a problem. Second, there's accounting depreciation. What is accounting depreciation? It's what accountants take off your book value because the asset is losing value. But it might have nothing to do with the economic depreciation. So inflation and accounting depreciation will often mean the book value of assets can diverge from what the original capital was invested or what's actually invested in projects today. So the implication is companies and projects with older assets will tend to have overstated accounting returns because the book value is lower. And if you throw in buybacks, book value can become a real mess. In fact, in about 10% of all publicly traded companies last year, the book value of equity was negative. Why? Because you had enough written off and you threw in a buyback, you ended up in negative territory. Well, of course, the response you will get from accountants is, what about fair value accounting? Well, after all, it's supposed to fix this problem, right? Bring assets up to current value. Well, here's why I think fair value accounting is pointless, and I think it's more of an accounting fever dream to make balance sheets relevant again. If you did mark the assets up, both company A and company B in our example to market, here's what you'd get. You'd get book values of 150 million marked up to market for company A and 30 million for company B marked down to market. If you compute the return equity based on these marked up book values, you know what you're going to get, right? Returns on equity of 10% for both firms. So here's the bottom line. If fair value accounting does what it's supposed to do, and I don't think it does, but if it does deliver this mark to market correctly, then every company in the market should earn its return on equity or return on capital, which makes the returns completely useless. Now, if fair value accounting fails, which I think is a more likely scenario, then I think you end up with a mishmash. You end up with numbers that are neither invested capital, the original invested capital, nor market value, and it becomes almost impossible to use accounting returns. I know this train's left the station, but it has meant that as accountants try harder and harder to mark up assets, they actually make the numbers less informative rather than more informative because they don't deliver the information I think accountants think they do. Now, in the example that we've just used, I've kept growth out of the equation. Now, not because growth cannot be dealt with, but it does mess up how we read both return equity and earnings yield. Now, to illustrate, let's go back to the original example. You had two companies. First company invested 60 million, made net income of 15 million a year forever. The second company invested 60 million, earned 3 million a year forever. It was a no-brainer. Company A was a much better business than Company B. Let's assume that I leave Company A as a no-growth company, but Company B, I put in a compounded annual growth rate of 50% a year for the next 10 years. Well, you can no longer deliver a slam dunk, right? Right now, Company A looks better than Company B, but if you put in the compounded annual growth rate, 5 years from now, Company B might be better. So growth makes it much more difficult to pick companies based on just what you generate as net income. By the same token, the earnings yield becomes tougher to read as well. Remember, in the no growth scenario, I said you could take the earnings divided by the price and it becomes a rough proxy for what the expected return on stocks will be. Well, if you have growth in earnings and there's reinvestment that goes with that growth, it's not as easy then to take the earnings yield and say that's my expected return. That was the whole basis for my implied equity risk premium argument, is the earnings yield is not a good proxy for the expected return on stocks when there's growth and there's reinvestment, and those things have to be brought in. Your net income is no longer your cash flow because it now has to get reinvested to deliver that growth rate. So bringing in growth doesn't change any of the intuition of what I've tried to bring across in this session, but it does make it messier to prove your case. There's one final point I want to make. I mean, clearly Company A is much better than Company B. Company A is a good company. Company B is a bad company. And you're saying, why doesn't Company B just fix its business, earn a higher return equity, or just leave the business? Let's see why those exit paths are not always available. In the case of Company B, if the reason you're earning well below your cost of equity is not because you have bad management or your factories are inefficient, but because your business has turned bad, because of disruption, regulatory change, I can't just ask you to go pick projects that earn more than 10% because there aren't any projects out there. That's like telling a diabetic to have less sugar or blood sugar and not providing them with insulin. The other option, of course, that people say, why don't you just leave the business? Well, implicit in that statement is the assumption that if you leave the business, you're going to get your 60 million back. In what universe? If you try to exit a bad business, take the business we own $3 million a year, where you originally invested $60 million, who's going to pay you $60 million to leave the business? In fact, if by divesting this business you get back only 25 million or 20 million, any number less than 30 million, you know what you should do? Stay in the bad business. You'll regret the original investment you made, but it's too late to fix it. It's a sunk cost. It's not easy to get out of bad businesses. I mean, I'd advise bad businesses to not try and grow, but I'm not going to be so quick to say, hey, you're a bad business, just liquidate yourself today. It might be actually better for you to continue as a business given that the mistake has already been made. So as I said, this entire session was premised on the comments that I saw on my data update and the responses to my explanation for why return on equity and cost of equity don't have to be equal in an efficient market. Now, many of these comments came from people with degrees and certifications in finance. And quite a few of these comments came from people who had finance professionals in their profile. I'm not going to take issue with them because I think the fault lies with those of us who teach finance, because it's a damning indictment that we let people get out of classrooms with masters in finance, MBAs, CFAs, and they still carry around these dangerously bad assumptions about what a return equity, return invested capital measure. So if nothing else, it was a reminder to me that I need, even in classrooms where I think that people have taken class in finance, revisit the basics before I go into more complex building up on the basics. Before you do valuation or corporate financial analysis, I think we need to kind of nail down what a return equity is, what a return capital is, and what an efficient market even means. What does it mean when you say a market is efficient? For those of you not finance professionals, but rely on them for advice, bankers, consultants, appraisers, I mean, this post should be a cautionary note that you shouldn't take them at their word. Just because they're professional doesn't mean that they always know what they're talking about. It's caveat emptor, buyer beware, because none of this stuff should be so complicated that each of us should have at least a basic understanding before we embark on conversations about it. So I hope you found the session useful, and I thank you very much for listening.